S&P Global got the green light to rate China's domestic bonds. China's central bank officially approved the entry of a stand-alone unit of the global ratings agency on Monday. This will be the first foreign-owned company allowed to rate Chinese domestic bonds. This move comes as part of China's national push to further open up its financial sector, but also amid lingering uncertainties surrounding trade talks with the U.S. The world's top three credit rating firms, Moody's, Fitch Ratings and S&P, have long coveted China's bond rating business. What does this move mean for China's credit rating industry? How will S&P blend in? And as the Chinese central bank said, it would continue to allow other eligible and globally acknowledged players into its market. What could be next? Joining the discussion in the Beijing studio is Professor Xianfeng, adjunct professor at Renmin University of China, and from Boston, Massachusetts, Professor Ravi, Ramamurti, director of the Center for Emerging Markets at Northeastern University. Gentlemen, welcome to The Point. First of all, a bit of an educational question, maybe to Professor Ramamurti. What is the credit rating services sector, and what do these services do to overall financial markets?
They play a very important intermediary role, and their role is really in bringing to light information that will help investors decide which bonds to buy. They're supposed to take an objective look at the financial condition of a bond issuer and give them a rating. It's like a report card on how strong the company is, how risky is it to lend the money, and for the investors then to decide if the returns, as measured by the yields on the bond, the interest rates paid by the bonds, are commensurate with the riskiness of the bond.
Okay. Professor Dai here in the studio, what is the current situation of the sector in China? And I would also give the next question to my guest just joining us from Shanghai, Dr. Huifeng, Chang, CEO of Canadian Solar Incorporated. Welcome to the show, but Professor Dai first. What is the current situation of the sector in China? And what are the potential opportunities in China's capital markets for overseas investors?
Yeah, if you look at China's bond market, there used not to be any defaults, right? But during the past couple of years, we began to see a lot of defaults. Relatively speaking, a lot. And that requires a service for the credit rating company, and for S&P, that's if you will, that's a good opportunity to come in and providing professional service, especially for global investors.
What about the potential opportunities in China's capital markets? Is there a number to it that we can put to it? What's the potential there, Professor Dai?
Yeah, from the global investor point of view, if you look at China's bond market, it is heavily invested by domestic investors. The number would be roughly 98% of the investors domestic.
Okay.
Like something like 2% from global investors.
Okay.
So that's great opportunities, great potential.
All right. In addition to registrating with China's central bank, the People's Bank of China, S&P has also registered with the National Association of Financial Market Institutional Investors, which means it will be able to rate local yuan-denominated bonds for international investors without tying up with local partners, basically what we're talking about. So, Dr. Chang in Shanghai, what access does that give to S&P, and how special is that for a non-Chinese credit rating company?
Hi, Liu Xin. Happy New Year.
Thank you.
Thank you for having me from remotely from Shanghai.
Same here.
Yeah, for the S&P, after the two approvals, and there are a lot of more details they have to apply for, such as the approval from NDRC and also approval from CSRC to cover the entire bond market in China, because some of the bonds are not being traded on the internet bank market, and they are trading in the Shanghai Stock Exchange, Shenzhen Stock Exchange. So there are a lot of more S&P can do in the China market, and wish them success.
From the investor's point of view, Dr. Chang, what are the potential impacts you expect because of this policy change?
Well, I think this policy change will allow the foreign portfolio manager, especially the bond portfolio manager, to invest in China. For example, company like us, Canadian Solar, we issue both dollar-denominated bond and RMB-denominated bond. But for the RMB-denominated bond, the coupon, the yield is higher. But in the domestic market, without S&P rating, a lot of foreign bond investor cannot buy our bonds. So with this change, we can issue our RMB bonds to the international investors.
Okay. Professor Ramamurti, what do you think is the significance of this step against the backdrop of downward pressure in the Chinese domestic economy and trade frictions with the United States?
Well, as the previous speaker mentioned, if you want to bring foreign capital in greater amounts into the Chinese bond market, you do need internationally recognized rating agencies like S&P and Fitch and Moody's to rate these bonds which are being issued in China. So one of the goals of the Chinese government is to increase the amount of foreign capital coming into the Chinese bond market. And in order to make that happen, and in order to upgrade the standards of the credit rating industry within China, you need to bring in companies like S&P and maybe down the road some of the other players as well.
There seems to be two options for S&P. Now, one is to bring its international rating standards to China, the other to adopt China's previous rating standards. Professor Dai, I don't know which option is more probable, or do we already know what's going to happen, and what would it mean for Chinese bonds? Excuse my outsider, not limited to scope of knowledge. Does it mean that when you judge Chinese bonds using international standards, many of these yuan-denominated bonds will be not attractive anymore?
Yeah, it's hard for S&P, at least in the short term, to do 100% in its own international practice. And it's also pretty hard to adopt 100% the Chinese local practice. I would imagine there is a combination of both, because there are some special practice in China, specific to Chinese situation. For example, some bond that might have implicit government guarantee, implicit. I mean, you really need the local knowledge to understand that.
Okay.
So there are some China-specific situations here.
Okay, but to have an international rating agency in the Chinese bond market, what would it mean for these bonds?
I mean, in the longer term, I mean, China is opening up, is to welcome S&P into China is one big step. So in the longer term, there has to be a convergence between the Chinese practice, standard, and the international standard.
Okay.
I mean, just in the short term, I would imagine it's very hard.
Well, are there concerns, Dr. Chang, then, are there concerns within China's domestic rating companies about the impact that S&P would bring? Should they be worried?
I don't think so. Like what happened in other industries, the banking industry, the securities industry, I think the Chinese companies have stood up pretty well in the face of the competition from the foreigners. Now, for the rating business, I think S&P, they have to make a decision either to follow the China rule, which is usually rate companies higher than foreign rating agency, or they are going to stick with the U.S. rule. But if they stick with the U.S. rule, there are some listing or trading rules in China that will have some issues. So I think for S&P, they have a lot of detail to sort out. But for the Chinese domestic rating companies, the market is very large, and being in the market for so many years, I think they still have a very strong competitive edge. Okay,
here's the golden question for all of you who have stuck with us despite the technicality of this question. Now, China and the U.S. are locked in a new round of talks in Washington, D.C., actually, as we speak. Now, Professor Ramamurti, some say S&P entering into China is just a gesture of the Chinese side to get a trade deal with the U.S., speculation, of course. How do you look at the timing?
Well, I think there is a a meeting of minds here in terms of what the Chinese government would like to get out of this and what the U.S. would get out of this. For the U.S., this is a way to open up, to provide market access to a key American company in this important activity. But for the Chinese also, this serves a very important purpose, which is to upgrade the local industry. And I think China has, the policymakers have a real issue to decide here, how far they want to modernize and upgrade and open up the Chinese market and make the yuan a key currency versus the government continuing to have control over the financial sector. If you want the first, you're going to have to give up a little bit of the second. I think this is the beginning of a process of trying to find the perfect balance between those two conflicting objectives.
Dr. Chang, your take on the same question. What about the timing? Is China trying to show to the U.S. that it is really serious about opening up and reforms?
Yes. Even though we know that the decision to opening the capital market further was announced last year, April, in Boao Forum. So we know that this news, the coming of S&P, didn't fall in the blue sky. Also, we have to know the fact that the foreign participation to China's equity and the bond market so far has been only less than 10%. Usually in the developing markets, this foreign participation is over 50%. So China has a lot to do to open the capital market further, so that vice versa, China will participate in the international market much further. Okay. So we can have a lot of more to do, further to do, and do them faster.
Okay, my last question to Professor Dai here. Just give me yes or no. Do you think in the near future China is going to follow up with more actions along the same line of opening up in the financial market?
Yes.
Okay, thank you very much. We're going to leave it there. Professor Dai Xianfeng, adjunct professor at Renmin University of China from Boston, Massachusetts. Professor Ravi Ramamurti, director of the Center for Emerging Markets at Northeastern University. And from Shanghai, Dr. Huifeng Chang, CFO of Canadian Solar Incorporated. And with that, we come to the end of this edition of The Point with me, Liu Xin. As always, follow me on Facebook and Twitter using the handle The Point with LX. Download the application called CGTN to watch the show on your mobile devices, or go to YouTube and look for CGTN The Point. Thanks for watching. You've got the point.